Disclaimer.
Iranian missiles are in the air. 27 American military installations across the Gulf are burning. The UAE, the beating heart of the world's gold trading network, just took a direct hit. The Strait of Hormuz, the narrow choke point that carries 1 in 5 barrels of oil on the entire planet, is now a live war zone. Every alarm in every trading terminal on Earth is screaming. And you, watching your silver position, are thinking exactly what every rational person would think. This is it. This is the moment silver explodes. Instead, it crashes. Silver spiked briefly, a violent lurch toward $100 an ounce that lasted just long enough to make you think you were right. Then, in a single Asian trading session, it collapsed back to $86. Not a dip, a crash. While missiles were still falling on American soil overseas, silver was selling off like a company that just missed earnings. If that makes no sense to you, you're in good company. Because financial media reported it, shrugged, and moved on. Nobody explained why. Nobody showed you the machine underneath. Today we fix that. Here is the first thing you need to understand, and it changes everything about how you read these markets going forward. Silver has 2 masters. Gold only has 1. Gold answers to fear, and fear alone. When missiles fly, money floods into gold. Clean, simple, almost mechanical. It has worked that way for thousands of years. But silver? Silver answers to fear and to industry. Solar panels consume it. Electric vehicles are built with it. Every smartphone, every circuit board, every satellite component moving through a supply chain somewhere in the world right now has silver in it. When you add it all up, industrial demand accounts for roughly 60% of all silver consumed globally every single year. That is not a footnote. That is the majority of what silver is. So here is the collision that almost nobody in financial media ever explains clearly. When missiles fly and war erupts, markets do not just price in the war itself. They immediately begin pricing in what comes after the war. The economic disruption, the supply chain fractures, the demand destruction, the recession risk that follows every major military escalation in modern history. And recession is the single worst thing imaginable for industrial demand. Factories slow down. Manufacturing contracts. Solar installations get delayed. EV production targets get revised. The industrial half of silver's identity, the majority half, gets repriced lower in real time, even as the fear half is pulling upward. That internal contradiction is the hidden machine. That is why silver does not simply rally when bombs drop. It tears itself apart, pulling in 2 directions simultaneously, and in the early phases of a crisis, the industrial fear is almost always heavier. What you saw in that Asian trading session was not chaos, and it was not a malfunction. It was the market doing exactly what this machine has always done, pricing the recession first. Now think about what that means for you personally. If you held silver going into that moment, your instinct told you this should be going up. When it went down instead, your next instinct was probably panic. Did I read this wrong? Is the safe haven thesis broken? Should I get out? That question felt by millions of silver investors in real time is exactly how this machine feeds itself. The confusion manufactures the selling deepens the dip, and the people who understand why it's happening watch patiently while everyone else funds their future gains. Let's zoom into the specific geography of this crisis, because the details matter more than most people realize. The UAE was not a random target. The UAE is where a massive portion of the world's physical gold moves through every single year, a critical transit artery in the global gold trading network. When it was struck, you would expect gold and silver to move together. Instead, gold absorbed the fear capital and silver sold off. In one single trading session, the market demonstrated something that would take a textbook 3 chapters to explain. When real crisis arrives, the market separates these 2 metals immediately. Gold gets the safe haven money, silver gets the recession discount. That divergence is not a glitch in the system. It is the system showing you exactly what it thinks silver is. And then there is the oil dimension, which ties the whole picture together. The Strait of Hormuz is not just a waterway. It is the circulatory system of global energy. 20% of the world's crude oil transits through that strait. A genuine disruption there does not produce one type of fear. It produces 2 simultaneously and in direct conflict with each other. Oil prices spike. That generates inflation fear. Recession risk rises simultaneously. That generates deflation fear. Silver sits at the exact intersection of those 2 opposing forces. Inflation fear says, buy silver. Recession fear says, sell it. Both signals arrive at the same moment, and in phase 1 of every major crisis in modern history, the recession signal wins the argument. Have you noticed how this pattern makes silver uniquely punishing for investors who only understand half the story? Somebody who reads about war and buys silver because silver is a safe haven gets immediately stopped out when it drops. They feel foolish. They tell their friends silver is unreliable. They walk away with a loss and a wrong lesson. Meanwhile, the investor who understands the split master dynamic who knows that phase 1 is the industrial sell-off and phase 2 is the monetary explosion, reads the same drop as a confirmation that the machine is working exactly as expected. Think about this more carefully for a second. If you were planning a vacation to Europe and your travel agent told you the price of your flight just dropped 30% because of a temporary disruption at the airport, would you cancel the trip or buy the cheaper ticket? Most people, when they understand the reason for the discount, make a very different decision than when they are panicking about the drop itself. That is the only difference between the investor who loses money in silver and the investor who builds wealth with it, whether they understand what they're actually holding. The financial media's failure here is genuinely costly for ordinary Americans. Every major outlet covers silver as a precious metal, full stop. They put it in the same breath as gold. They call it a safe haven. And technically, in the right conditions, that is accurate. But they skip the other 60% of the story. The industrial identity, the dual master dynamic, the phase structure that governs how silver behaves in every major crisis. So when this split plays out in real time, millions of viewers watch silver crash during a war and conclude that markets are irrational, or that silver is broken, or that they made a mistake buying it. None of those conclusions are correct. The market is functioning perfectly. Silver is doing exactly what it always does. And the mistake was never owning silver. The mistake was not understanding what silver actually is. So let's make sure you understand it. Silver is a monetary metal when the dollar is under pressure and fear dominates. It is an industrial commodity when economic growth expectations are the primary driver. In normal conditions, both identities coexist in an uneasy balance. But in a crisis, a real crisis, the kind where missiles are hitting American bases and oil choke points are threatened, the two identities violently separate. Phase 1 strips away the industrial premium as recession fear floods in. Phase 2 restores and then dramatically expands the monetary premium as the inflation the crisis created arrives in the real economy. That sequence, industrial fear first, monetary explosion second, is not a theory. It is a documented historical pattern that has repeated across every major crisis of the last 50 years. And understanding it does not just explain what happened in that Asian trading session when silver crashed from nearly $100 to $86. It tells you, with remarkable precision, what the next chapter of this story almost certainly looks like. Because here's the thing about a machine this consistent. Once you see it clearly, you stop reading the news like an investor chasing price. You start reading it like an engineer monitoring a process. And the process right now, in March of 2026, with missiles in the air and oil at risk and the dollar under structural pressure, is running exactly on schedule. Once you see this mechanism, you cannot unsee it. Because this is not the first time silver has done exactly this. The pattern repeats. 1973, 1980, 2008, different decades, different flags on the crisis, same machine running underneath. And understanding each of those episodes doesn't just explain what is happening right now. It tells you with uncomfortable clarity what happens next. Let's go back to October 1973. Egypt and Syria launch a coordinated surprise attack on Israel on Yom Kippur, the holiest day in the Jewish calendar. The United States responds immediately, backing Israel with $2.2 billion in emergency military aid. The Arab members of OPEC respond just as quickly. They announce an oil embargo on the United States. Almost overnight, the price of crude oil quadrupled, from roughly $3 per barrel to nearly $12. American inflation, which had been running at a manageable 3.3% in 1972, surged to 11% by 1974. Gas lines stretched around city blocks. The economy entered recession. Now, what did silver do? Almost nothing at first. That is the part nobody remembers. The initial reaction was muted. Markets priced the recession first exactly as they always do. Industrial fear dominated. The economic slowdown that the war and embargo implied pressed silver down before it could rally. And most people who were watching silver in late 1973 and 1974 concluded, reasonably but completely incorrectly, that silver was not responding to the crisis and therefore wasn't worth holding. Then phase 2 arrived. The inflation that the war created, the actual grinding, dollar-destroying inflation that the oil shock generated, started working its way through the entire American economy. Energy costs embedded themselves in the price of everything. The Federal Reserve fell behind the curve. The dollar weakened. And silver, sitting at $1.50 an ounce in the early 1970s, began what would become one of the most extraordinary commodity moves in modern American financial history. By January 1980, silver touched $49 an ounce. That is a gain of over 3,000% from the pre-crisis base, delivered not because the war was good for silver, but because the inflation the war created was catastrophic for the dollar, and a collapsing dollar is the single most powerful environment silver can exist in. Phase 1 was the recession fear. Phase 2 was the monetary explosion. The investors who endured Phase 1 and held became wealthy. The investors who sold in Phase 1 funded their gains. The story repeats almost identically just a few years later. Iran's Islamic Revolution in 1979 shuts down between 3 and 4 million barrels of daily oil production almost overnight. Iraq seizes the opportunity and invades. Oil surges again. Stagflation, the brutal combination of high inflation and stagnant growth that economists once considered theoretically impossible, grips America. You might have a parent or grandparent who remembers this period. Mortgage rates above 18%, grocery prices climbing every week, a general sense that the American economy had fundamentally broken. Same sequence played out in silver. First, industrial fear arrived. Recession risk pressed the metal down. Then came the dollar collapse that the energy shock generated. Silver ran from roughly $6 an ounce in early 1979 to $49 by January 1980, an eightfold move in 18 months. Same machine, different flag on the crisis, same internal logic driving the outcome. But if those two episodes feel distant, if 1973 and 1979 sound like history class, then 2008 is the one that should feel personal. Because a generation of American investors lived through it and learned exactly the wrong lesson. When Lehman Brothers collapsed in September 2008 and the global financial system came within days of complete failure, silver crashed 50% in a matter of weeks. Not gradually, violently. Industrial demand expectations collapsed as the recession became undeniable. The safe haven argument was completely overwhelmed by the industrial fear. Investors who had bought silver specifically as a store of value watched it cut in half, while the crisis they'd bought it for was actively unfolding. Millions of them sold, convinced silver was broken, concluded the safe haven thesis was a myth. Then the Federal Reserve started printing money. Then the dollar started weakening against hard assets. Then the global economy, battered but recovering, started rebuilding demand. And silver, which had bottomed near $9 an ounce in late 2008, ran to $49 by April 2011. That is a 4% gain in under 3 years, delivered to the investors who were patient enough, or informed enough, to understand that Phase 1 always precedes Phase 2, and that the crash was not a malfunction, but a setup. Do you see the structure now? Industrial fear arrives first. Dollar destruction arrives second. The investors who survive Phase 1 become wealthy in Phase 2. The investors who panic sell in Phase 1 literally fund the gains of everyone who held. It has happened 3 times in the last 50 years with remarkable consistency. And every single time the mechanism was identical even as the headlines looked completely different. Here's what should grab our attention about right now, though. Because this is where the current moment separates itself from every previous cycle in a way that most analysts are still not adequately pricing in. Every previous silver cycle, 1973, 1979, 2008, hit a market where physical silver supply was broadly adequate. Mines were producing, inventories were stable. The price swings were driven almost entirely by demand-side forces. Fear in, fear out. Industrial demand up, industrial demand down. The supply side was essentially a neutral factor. That is no longer the case. According to the Silver Institute, the silver market has now recorded 5 consecutive years of supply deficit. Every single year from 2021 through 2025, the world consumed more silver than it produced. The cumulative shortfall over that period reached nearly 820 million ounces, roughly equivalent to an entire year of total global mine output, simply gone from available inventory. And replenishing it is not as straightforward as building new mines because over 70% of silver produced globally comes as a byproduct of mining other metals, copper, zinc, lead. You cannot simply decide to produce more silver when prices rise. The supply chain does not work that way. The metal comes out when the base metals come out on their own timeline, regardless of what silver's price is doing. What this means, practically, is that the structural foundation underneath silver in 2026 is fundamentally different from any previous cycle. In 1973, the Phase 2 rally was built on monetary pressure alone. In 2008, same story. Dollar weakness and Fed money printing drove the move. This time, Phase 2 launches from a physical scarcity floor that did not exist in any of those previous episodes. The inventory cushion that once absorbed demand spikes is depleted. The supply response mechanism that historically capped rallies is structurally impaired. And the war in the Gulf, the same war that is currently crashing silver through the familiar Phase 1 dynamic, is simultaneously adding new pressure to an already stressed physical market. The spring was already compressed before the first missile launched. The war did not create the tension, it just told us that the release is getting closer. Most financial channels covering this story right now are asking the wrong question. They are debating whether silver goes up or down from here, treating it like a coin flip, like a gut call, like something you just have to feel your way through. That framing is not just unhelpful. It is the reason most retail investors consistently buy high and sell low in this market. The right question is not up or down. The right question is, Where are we in the sequence? Because once you know where you are in the sequence, the math practically writes itself. So let's run it. The most reliable map silver investors have is the gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold. It sounds simple, almost too simple, but this single number has an extraordinary track record of signaling where silver stands in its cycle. When the ratio rises above 80, silver is historically in phase 1, undervalued, beaten down, priced for recession, hated by the market. When it compresses back below 50, silver is in phase 2, monetary explosion underway, industrial demand recovering, the machine running in silver's favor. In April of 2025, the gold-silver ratio broke above 100 to 1. Let that land for a second. It took more than 100 ounces of silver to buy a single ounce of gold. That was the most extreme reading since the COVID crash of March 2020, the last time in modern history the ratio reached that level. And here is what the historical record shows every single time that ratio has spiked to 90 or above. What followed was not more pain for silver. What followed was one of the most powerful silver rallies in a generation. After the 2008 spike to 90.1, silver ran from $9 to $49, and the ratio compressed all the way back to 30.1. After the COVID spike to 125.1, silver surged from $12 to $30 in a matter of months. After April 2025's spike above 100.1, silver rose 147% through the remainder of the year, more than doubling gold's already impressive 67% gain over the same period. The ratio today, after this war-driven pullback, sits near 57.1. The long-term historical average is 50.1, and at current gold prices, above $5,200 an ounce, fair value at that 50.1 average puts silver right at $100. That is not a speculative target, that is arithmetic. That is where silver trades when the ratio is simply average, not stretched in silver's favor, not at a bull market peak, just normal. Previous bull market peaks in this ratio have compressed to 41, which at current gold prices implies $130 silver. And if this conflict expands, if inflation accelerates beyond what the Fed can credibly contain, analysts tracking this market are projecting a technical pathway that opens toward $250 to $350, levels that sound extraordinary until you remember that silver rose 144% in 2025 alone and is already up 42% in early 2026 before this pullback even began. Now let's talk about the inflation feedback loop that the war itself is building, because this is the part of the story where 1973 and today overlap so precisely it becomes almost eerie. The same strikes on Iranian infrastructure and Gulf shipping routes that initially crashed silver are simultaneously doing something else entirely in the background. Marine insurance premiums across Gulf shipping lanes have already risen sharply. Gulf equity markets have declined. Oil is pricing in sustained supply disruption risk. Every one of those pressures feeds directly into the American consumer's cost of living. Energy prices, shipping costs, manufacturing inputs, food supply chains. The war-driven inflation is not a future hypothetical. It is already entering the pipeline. The Federal Reserve now faces the same impossible choice it faced in 1973 and again in 1979. Raise rates aggressively to fight the war-driven inflation, and you accelerate the recession that is already being priced into silver's industrial component. Or ease into the inflation, let the dollar weaken, and watch hard assets reprice dramatically higher as the purchasing power of paper money erodes in real time. There's no clean exit from that dilemma. Both paths lead silver higher. The aggressive rate path delays phase 2 and deepens the phase 1 dip. The accommodative path accelerates phase 2 and compresses the timeline. Either way, the destination is the same, only the route differs. And here is what makes this cycle genuinely different from every previous one, the thing that keeps coming back to the supply deficit, because it cannot be overstated. In 1973 and 2008, phase 2 was driven by a single engine: monetary pressure, dollar weakness, inflation. Powerful, but a single force. This cycle has 2 engines running simultaneously, and the second engine is something that simply did not exist in previous cycles at this scale. Solar panel installations globally are projected to require between 120 and 125 million ounces of silver in 2026 alone. Electric vehicle production adds another 70 to 75 million ounces on top of that. Grid infrastructure build-out, data center expansion, advanced electronics manufacturing. Each of these adds more. The total industrial demand picture for silver is not shrinking. It is structurally growing year over year, driven by the energy transition that every major economy on Earth has committed to, regardless of short-term economic conditions. The industrial demand that is suppressing silver right now, pricing in recession fear, weighing down phase 1, is the exact same demand that becomes rocket fuel the moment economic conditions stabilize and industrial activity resumes. Think about what that means structurally. In every previous cycle, phase 2 was essentially a pure monetary trade. Dollar goes down, silver goes up, and then industrial demand eventually returns and adds a secondary boost. This time, the industrial demand that returns in phase 2 is larger, faster growing, and more structurally embedded than anything the silver market has ever absorbed before. It does not just add fuel to phase 2, it puts a permanently elevated floor underneath silver that previous cycles never had. Even in the next recession, the one the market is currently fearing, industrial silver demand slows but does not collapse because solar installations and EV production have multi-year government-backed commitments that do not simply vanish when GDP contracts by 2%. So let's bring this home. The people who sold silver during the 2008 crash missed a 444% run that played out over the following 3 years. The people who sold during the COVID crash of 2020 missed a 150% run that unfolded in just 8 months. Right now, in March of 2026, silver is doing exactly, and we mean exactly, what it did in both of those moments. Crashing in phase 1, being sold by investors who do not understand what they are holding, building the base from which phase 2 launches. The war in the Middle East did not break the silver story, it confirmed it. The missiles that struck American bases across the Gulf are not a detour from the sequence. They are the sequence announcing itself out loud. The inflation those strikes will generate is coming, the dollar pressure is building, the supply deficit is already there, 5 years deep, with no structural path to rapid resolution. 3 forces, same direction, same destination. The investors who understand the machine are not panicking right now. They are not refreshing price charts every 20 minutes looking for reassurance. They are watching a process they recognize, in a moment they have studied, with a historical pattern that has repeated with remarkable consistency across more than 50 years of American financial history. And they are patient. Not because patience is comfortable, but because they understand that the discomfort of phase 1 is the tuition you pay for the returns of phase 2. The question was never whether silver was safe in a war. The question was always whether you understood what you were holding well enough to stay in the room when everyone else was running for the exit. Now you do.